Welcome to the World Market Podcast, where we explore the intricate dynamics of the global economy. In today's episode, we'll delve into comprehensive breakdowns of the current economic landscape, aiming to shed light on various economic indicators and the factors that may influence the financial markets. Our journey begins with a shift in market sentiment, reminiscent of the turning tides of a ship navigating the vast seas. Not so long ago, the financial world was rife with apprehensions about an impending market crash. Conversations buzzed with anxiety, and many wondered if their investments were on the precipice of peril. Fast forward to today, and the narrative has evolved. The talk is no longer of doom and gloom. Instead, it leans toward a gentle, soft landing in the financial landscape, with no recession in sight. It's a significant shift in perspective, one that begs our attention and analysis. Now let's unravel the enigmatic world of interest rates. The economic realm is abuzz with chatter about the rapid increase in U.S. interest rates. A noteworthy increase of 4.88% has taken place, an unprecedented development that warrants a closer look. This sudden surge in interest rates raises a host of questions about the potential impact on borrowing, spending, and investment. It's a variable that requires careful examination in understanding its implications for the broader economy. One cannot discuss the current economic landscape without delving into the extraordinary phenomenon of quantitative easing. The U.S. economy has experienced an unprecedented influx of trillions of dollars. It's a monumental move with few historical precedents, and the implications are still unfolding. The world of finance watches with bated breath to understand the consequences of this dramatic economic intervention. The relationship between quantitative easing and the broader economic landscape is a subject of intense scrutiny and debate. Now we arrive at a critical juncture, the future of the U.S. economy and the looming specter of a potential recession in 2024. The outlook varies widely, with different entities offering contrasting perspectives. The Federal Reserve staff expresses the most optimism, suggesting a 0% chance of a recession. Contrastly, CEOs across the corporate landscape are notably less sanguine, with a staggering 84% anticipating a recession. This glaring disparity in outlook underscores the complexity of the economic landscape and the myriad of factors that influence these different viewpoints. A fascinating facet of the current market landscape is the undeniable dominance of 7 behemoth companies in the S&P 500 index. These giants, including Meta, Facebook, Nvidia, Apple, Microsoft, Alphabet, Amazon, and Tesla, collectively account for a staggering 28% of the index's performance. Their influence on the broader market is significant and worth careful consideration. While these corporate giants exert their dominance, the performance of smaller companies, both mid-cap and small-cap, tells a different story. Large-cap companies continue to flourish, but the small-cap companies are facing significant challenges in the current economic environment. The disparities in performance between different categories of companies provide valuable insights into the complexities of the financial landscape. Now let's turn our focus to the mounting credit card debt in the United States, a phenomenon that has crossed the $1 trillion threshold. This escalation in credit card debt, coupled with the accompanying increase in credit card interest rates, has profound implications for individuals managing their finances. As the interest rates on credit card balances rise, the financial burden on consumers also grows. It's a critical issue that merits attention in our analysis. Another financial hurdle on the horizon is the return of student loan payments. During the COVID-19 pandemic, millions of Americans were granted a reprieve from their student loan obligations. However, the time is fast approaching when these deferred payments will come due. The financial implications for individuals managing these loans are considerable, and it's a topic that's poised to impact the economic landscape in the coming months. Now let's shift our lens to the real estate market. The increase in mortgage rates emerges as a pivotal factor. The housing market, traditionally a barometer of the overall economic health, has been experiencing turbulence due to the surge in mortgage rates. It's a trend that can potentially impact real estate transactions, home values, and the broader economy. As we explore the intricacies of the financial landscape, we encounter the concept of the lag effect. This intriguing phenomenon refers to the time delay between the cessation of interest rate hikes and the emergence of a recession. Historical data illuminates this concept, suggesting that on average, it takes approximately 11 months from the end of interest rate hikes for a recession to manifest. It's a compelling correlation that provides valuable insights into the potential future of the economic landscape. Our journey takes us to the corporate world, where corporations grapple with their own set of challenges. Corporate debt maturing is on the rise, with billions of dollars due for payments in the coming years. The implications of managing this size maturing debt has far-reaching consequences for corporations of all sizes. And finally, the U.S. government is not exempt from the financial pressures that pervade the economic landscape. With a substantial national debt, any increase in interest rates translates to higher interest expenses for the government. This, in turn, has a ripple effect on government budgets and the broader economy. In conclusion, we caution viewers to exercise prudence and consider their individual risk tolerance. It's essential to be prepared for potential economic challenges and uncertainties. As we navigate these uncharted waters, the wisdom of only the paranoid survive takes on a new resonance in the ever-evolving economic landscape. Thank you for joining us on this edition of the World Market Analysis. Our commitment is to keep you well informed about the intricacies of the financial world as it unfolds.